Rule of thumb number 5. Buy the dip. What to know? Buy low, sell high, is a core tenet of investing, but don't wait for the markets to sink to get started. It's typically a good idea to start investing sooner rather than later. Consider what you can do to start working toward your goals today. When to follow it. 1. The Fed has begun cutting interest rates. Over the past 70 years, there have been 3 bear markets in which investors benefited by buying stocks that were headed down but not at the bottom yet. Though there's no guarantee that this trend will continue, the common thread in these past cases was that interest rates were also headed down. 2. You have a crystal ball. Markets rarely hit bottom in one fell swoop. They tend to take jagged paths to the bottom and the top. Buying as the dip starts often ends up amplifying losses more than it results in long-term gains. When to break it. 1. You're new to investing. Don't wait for a dip to start investing. Morningstar Director of Personal Finance Christine Benz notes that, for most new investors, a slow but steady savings pattern is best. 2. You're already holding cash. Research from Richard Bernstein Advisors suggests that portfolios that held 100% cash through a market trough and shifted to stocks 6 months later outperformed portfolios that invested in stocks for the entire period. 3. You're investing in previous market leaders. When the market struggles, companies experience leadership changes and fund managers adjust their holdings. Don't assume previous market winners will reclaim their titles. Rule of thumb number 6. Withdraw no more than 4% annually from your retirement portfolio. What to know? In addition to Bill Bergen's 4% rule, consider anticipated changes to your overall spending patterns. Research from former Morningstar researcher David Blanchett found that individuals often experience a decline in discretionary spending throughout the course of retirement as they become less active, though total costs, including healthcare expenses, follow a retirement spending smile pattern. Think about income consistency as well as your desired lifestyle in retirement. Would a fixed or flexible withdrawal strategy better enable you to fulfill your goals? When to follow it. 1. You want to prioritize stable cash flow. The safe starting withdrawal rate fluctuates each year as the market environment changes, but Morningstar research finds that 4.0% or lower is typically a good yardstick for consistent income. 2. 20%, 40% of your portfolio is in equities. In a down market, Morningstar research shows that even a 2% starting withdrawal, much less 4%, can be dangerous for an all-equities portfolio. 3. You want to leave more to your beneficiaries. Reducing the withdrawal rate makes it more likely that you'll have funds to leave to your heirs. When to break it. 1. You're willing to employ a flexible withdrawal strategy. For example, not fully adjusting your withdrawal rate for inflation or taking less in down markets. These approaches inherently create cash flow volatility but can also enlarge your starting and lifetime withdrawals. 2. Guaranteed income will supply some household spending. If part of your income comes from Social Security, a pension, or an annuity, changes in portfolio spending may be more tolerable. Rule of thumb number 7. Maximize matching contributions to your employer's retirement savings plan. What to know? Nearly half of all retirement plans with a match have a match ceiling of 6%, according to research from T. Rowe Price. Free money typically isn't something to turn down, though there can be exceptions. For instance, maybe you have an immediate need that takes precedence over long-term goals. When to follow it. 1. Pretty much always. Maximizing matching contributions is a good idea for anyone in a stable financial situation. It's money that you can't get elsewhere, and it'll only compound over time. 2. Your retirement plan offers auto-enrollment or auto-escalation. If you're automatically enrolled, you're ahead of the game on making saving a habit. Some retirement plans also offer auto-escalation, where the percentage you contribute ticks up slightly over time. 3. You need to catch up on retirement savings. If you got a late start to retirement savings, additional funds provided by your employer are particularly beneficial. When to break it. 1. You have high interest debt. These expenses are top priority. High interest credit cards or student loans can set you back more than matching contributions to a retirement plan will set you ahead. 2. You don't have adequate emergency funds. Having 3 to 6 months of savings is another core priority to put above retirement savings. Once the essentials are covered, you can reprioritize retirement planning. Rule of thumb number 8. Prioritize hedges against inflation. What to know? Though workers' salaries don't always keep pace with inflation, they typically see enough adjustments to help maintain your purchasing power. You may need to be more concerned about preserving purchasing power in retirement when assets are more fixed. Based on your desired timeline for starting portfolio withdrawals, you can identify how much of a priority inflation hedging should be. When to follow it. 1. You have a lot of bonds. Inflation is a greater threat to a bond-heavy portfolio than a stock-heavy one. Bond investors may choose to prioritize inflation protection with Treasury inflation-protected securities. 2. You need funds in the short term. Though an all-cash portfolio isn't a winning long-term strategy, it is a good way to ensure you have some funds accessible during an inflationary environment. When to break it. 1. You have an equity-heavy portfolio and a longer time horizon. Stocks tend to be a fairly resilient long-term inflation hedge because companies tend to have a certain amount of pricing power. They may be able to pass their increased expenses along to their consumers or may not be particularly dependent on the cost of raw materials to maintain their profit margins. 2. You're considering niche asset classes. Returns on supposed inflation hedging asset classes like gold or cryptocurrency are unpredictable. Don't start investing in niche asset classes purely in the interest of inflation protection. 3. The focus on inflation is causing you to ignore other portfolio risks. Inflation hedging efforts shouldn't come at the expense of managing other risks like recessions or geopolitical tensions.
Friends, thanks for watching. Please subscribe my channel for more videos.